Good evening, Gene Inger. This is the Monday evening comment here on the holiday. As you know, on Monday, all foreign markets generally declined heavily, 7%. 5%, 4%, depends on the market, and the Dow Jones Industrial Futures are down approximately 520 at last report, with the S&P down 6,000. Well, this is no great surprise. Some members at IngerLetter.com have asked that I comment upon it. All I'll have to say on this subject is we've been predicting something like this, especially after the nominal expiration, and we have felt when we take a look at the S&P on a cash basis that it was not so much the breaking of the recent lateral lows that took place, but rather it was the breaking of the highs, the failure to make higher highs here, and here that was important. These were obviously going to come out. This was your downtrending pattern. So as we look at this on the weekly basis again, and we shift briefly to a chart of the Dow Industrials as we do every day normally, what we will observe is simply that this market is going to have a conclusion in terms of panicky peddling of what make some sense, even though the banks and the mortgage companies are taking back their off-balance sheet assets, writing off losses, seeking new capital, the Fed making creative use of its discount window with new auctions, different collateral, and so on. And this has helped reduce the credit spreads that ballooned late last year, calming the lending markets. But what it's not going to do is create available credit, and that means that the credit crunch and the derivatives issues are by no means done. There's no way they can repackage these securities for resale, and they're not going to carry them on their own books. So bankers will become conservative bankers, and this will simply take time to work through the system. If the market opens up on Tuesday morning, this is since you know we've been calling for this and have said cash is king for the past year, then I indeed would say if it opens up, it has no chance of extending and will plummet. Then we'll see what happens with the roiling around the FOMC meeting, and I'll be here with special comments around that, of course, in the afternoon. If the market does crash at the opening and rebound sharply, which is what all the pundits will be predicting, be very careful. Stocks are not bargains based on multiples or other factors generally in the big caps, and I predicted that the big caps would be the ones where everyone was telling you to go into, and that's where the greatest danger actually was, as you're obviously seeing now, not the small ones that are already hit. And I think you will see this again proven tomorrow. And then if you open up, drop down, come down, have a market that then roils through the Fed's decision and then rolls over and tanks, that's when the panic of 2007 that we forecast beginning in May and June of last year can become the crash of 2008. We certainly would not get negative into weakness, obviously, in the morning. That's a given. But be very careful if instead you get an early Fed rate cut, which I don't think they're going to do given the proximity of the timing of the meeting. If they do, they're really worried, and that's not going to help. Remember, that is pushing on a string. Join us at IngerLetter.com tomorrow. Good night.